Hey guys, I hope you are all having a great weekend. As we start yet another week holding AMC and GameStop, I wanted to make a video once again centered around the economic crisis that we are headed into. This video was supposed to come out yesterday, but I wanted to add some extra information to it that adds that extra layer of wrinkles, as some of the added content will definitely clarify some of the confusion many people have had. Now, if you have watched my previous videos, you would know that one of the catalysts that I think would be strong enough to trigger the squeeze would be an economic crash. It seems that every sector of the economy is struggling or slowly kicking the can down the road in order to prevent this from happening, but the worldwide economy is doing a very poor job at fixing the problem, as most efforts are concentrated at delaying the inevitable. In this video, we will focus on inflation, which is something that I have briefly talked about here and there in some of my previous videos, in particular with the ever-rising gap between prices and their real valuation. Remember that the overall problem with inflation isn't direct or exclusive to GameStop and AMC, but due to the current circumstances that these stocks find themselves in, they have the most to win. This is an issue that encompasses all stocks, but we only care for these two stocks, and as such the focus of this video will be to uncover the issue with inflation, dissect it analytically, talk about what it is and how it affects our beloved stocks. We need to break this down little by little so that we can temper and set realistic expectations. After we are done talking about this, we will discuss some of the events that took place today as well as provide some technical analysis that will help recap today and give you a good idea what might be in store for us. Today's video is going to add a couple of wrinkles to your brain as promised. The only thing I ask is for you to drop a like on the video, and comment below if you found the information enlightening or helpful. Thank you to all of you for taking time to watch this video, and a big shout out to every single member in this community that has pledged a Patreon or made a donation contribution to this channel. This channel benefits out of your kindness and wholesomeness. If you would like to contribute, links are below in the description. With that said, let us transition into the reason you are here. The entire world economy was disrupted in 2020 when the events of the virus halted economies across the world. However, throughout the process, officials kept touting that the United States along with other nations would have strong rebounds. Much of this was due to the belief that once health officials found a way to remedy and keep on producing as they always did, once they could restart things, that everything would go back to normal. As usual, this was nothing more than a pipe dream, because the problems that the United States has been ignoring and suppressing all came out and passed the threshold by which the United States needed to maintain in order to keep kicking the can down the road and not address them. Inflation is one of the consequences that happened to arise to exponential levels. Without complicating it too much, one of the main driving forces behind the reverse repo market exploding is precisely inflation. Inflation is a growing problem for everyone in the financial sector. Almost all the bonds available for corporate have negative yields, which poses some serious issues. Let's break this down a little more. As we have seen during the past couple of weeks, the Fed has been conducting reverse repo operations which have been moving up week by week, almost passing $1 trillion for the first time a week or so ago. This has left other members such as banks and even hedge funds with a ton of cash in their hands. As said in a previous video I did less than a month ago, the market truly works when there is a balance of collateral and cash. We need treasury bills, gold, or as we were talking, corporate bonds. When banks or other members are deprived of collateral, or other assets of value, and are left with a ton of cash, this becomes a serious problem because that diversification is extremely needed for a variety of reasons. Under normal conditions, this would be a bad place to be, but these members would figure out a way to deal with it in a timely manner. But we are most certainly not living in normal conditions. We are living in the exact opposite of normal conditions, because inflation is skyrocketing. Among other problems that inflation imposes on these members, one of the bigger ones is that due to these entities having way too much cash in hand, they are losing money. That is right, let me explain. With inflation rising, it means that the value of the dollar decreases because the purchasing power of that dollar is decreased over time. If you were a bank with $500 billion 2 years ago, that money could afford you a lot more things than it could do right now, because the prices of things keeps going up and increasing. In fact, inflation is such a huge problem that the very psychological anticipation of it makes prices rise up, making the problem incredibly difficult to deal with, which is the case right now. Let's go back and bring this up to context. With inflation going up exponentially, bond rates yielding in the negative are going to stay like that for the time being unless a sudden disruptive force changes this. Inflation is essentially going to eat up this asset. Reading and going through some articles and documents, it appears that the majority of bonds that are yielding positive returns are those that are very risky, meaning that investors essentially have to gamble on getting lucky if they decide to go with bonds. We had talk about the Fed increasing the interest rate for holding members' cash, but then them leaving the short-term borrowing rate at near zero, which means nothing has really changed. Now, many are wondering what this has to do with GameStop or AMC, especially after I said that this inflation problem is something that affects everything. Well, this has absolutely everything to do with our stocks. Due to the growing depreciation of value on the cash that members of the market have, this will eventually keep on getting eaten and there is nothing they can really do but bid their time. There will be a point where even with all that cash they have, due to the rapid growth and escalation of inflation, a lot of this money will be eaten up easily and higher amounts will be needed to provide for the liquidity risks that the DTCC has recently increased with all their filings. Essentially, inflation will cause hedge funds and banks to have to provide higher amounts of cash over a relative short amount of time to the point where they will risk more exposure to being margin called. Now, being margin called is not the end of the world, but when it starts happening too often, then the stress levels start getting out of hand, as one very famous test recently indicated, and things get out of hand extremely fast. But let's go back a little bit, because I want to dive a little bit deeper with you in this fascinating topic, as there is much more to derive from this than the simple nature of things. Banks have too much skin in the game, as so do hedge funds right now. The economy is sort of the noose around their necks, while inflation is the effects of global warming. Their exposure and risk management has been so risky they are stuck in a really bad position, and this we will think of as a block of ice which they stand on. With inflation rising, much like global warming, the noose on their necks is tightening relatively fast. They will soon have nothing to stand on because inflation will eat it all, or the ice is melting so fast they don't have time to wiggle themselves out of the noose. This is something that I have seen on many social media posts from people who work with banks. Without releasing too many details that could get them fired, they do share that leverage is at an all-time high and that inflation is becoming a serious problem for them. This could be a serious reason why all of a sudden we are seeing a lot of activity within banks in the middle of the night, with a bunch of office lights on when that wasn't the case before January. Now, one of the questions I know I will get is what happens if the government helps hedge funds out by fixing the inflation problem. The problem with inflation is that though the government does have a part in it, it is not something that can be fixed with a quick update. For once, inflation arises from the devaluation of the dollar, which as we have seen, is already happening. In fact, with the rise in cryptocurrencies, many people are betting more on it as a more stable means of currency than the dollar, something that the government is becoming more scared and aware of. When you have an economy, or actually, when you have a country such as the United States, and they consistently fail to address serious issues within its economy, such as housing, healthcare, education, wages, people quickly start losing hope and faith on its monetary valuation, which leads to inflation. It is hard for me to say, but the United States is on a direct path to losing its spot as world leader. Many businesses are relocating, and though I believe globalization to have been a great answer to many of the world's problems, its implementation and outsource of jobs while not producing a realistic answer to the citizens of the nation will be one of the biggest factors, if not the biggest, as to why we are heading in this direction. Part of this starts with an inflation crisis, which is what we are seeing. The fact that the problem isn't solved yet and only seems to be getting worse as we go on shows just how out of control things are from the government. I said before, I still do think the Fed knows exactly what is doing and that they are sort of maintaining the situation as it is for as long as needed in order to let the bad actors get screwed over first so that they can then jump in and re-establish a more balanced market. But what happens after is anyone's guess, and mine are not optimistic, but that is a topic for another video. Let's talk about inflation and its implications with GameStop and AMC a tiny bit more. We have talked about housing, and how it is becoming an increasingly pressing issue. A very important article came out not too long ago about how BlackRock is essentially outbidding everyone. When looking through the numbers, and the media is starting to seriously catch up to this, it appears that we are now slowly entering a house market bubble. The reason for this is that the increased demand that we are seeing from it is not necessarily from a normal market, but from big corporations driving up the demand. Since these big corporations are in the game now to buy as much as they can to outbid everyone in the market because they want to rent property and starve people out of ownership to make a lot of money, demand for new mortgages is decreasing while the supply continues to increase. The issue with this is that prices also continue marching upwards as well. How are these corporations destroying housing demand, you might ask? The methods are simple but incredibly sinister. I want to thank Mark for this revelation. Bit shout out to you, brother. Affordable housing is no longer a suitable option, because the profit margin falls very short when compared to a rich house. Rich houses, when there is an economic halt, have higher difficulty finding people to buy them, which drives the prices of these same properties down and drags along the rest of the housing market with them. Big corporations are running wild buying these houses, partly in due because of the reasons we covered a couple of minutes ago, as they need to find anything to invest their excessive amounts of cash. They are desperate to diversify and will have no trouble purposely causing another market housing crisis bubble like we had in 2008 in order to try to stay alive. The thing that makes this a bit worse for the incoming bubble burst is that the bursting process is delayed, because corporations have yet a ton of cash to spend and people are also buying property like crazy. Remember, the issue lies with that it's always the same big organizations and wealthier people, which represent a small cohort, that can sustain this unrealistic bubble until they can't anymore. I wanted to mention housing because I have touched on it before on my channel but not really given an explanation as to the implications it has on the overall economy, and I wanted to tie it in with the issue with inflation. Essentially, prices for houses are inflated because there is an artificial demand for more, even when nobody is even living in these houses. The reason for this is that corporations are buying like crazy because they need to diversify all that cash sitting around that is about to get eaten up by inflation. But housing is not going to save them because by allocating too much too quick like they are doing, they are essentially putting a time bomb on the bubble they themselves have created with the housing crisis. Welcome to 2008 again, ladies and gentlemen. Lastly, we talked about some of the regulations imposed by the DTCC around early May as a mean to boost up their risk management. As a result, at the exact same time, we started seeing cryptocurrency prices start dropping like flies. Many on the crypto community still wonder why this was, but us apes know that it was done by hedge funds. The reason for withdrawing all of that was because the same DTCC regulations stated they could not count crypto as a holding asset on a balance sheet. I wanted to touch on this because many have asked if hedge funds don't have assets in crypto, and the reality is that crypto isn't viewed as a realistic asset, and therefore a ton of it if not most have been withdrawn in order to accommodate themselves to fit the new liquidity requirements, which has left the crypto community reeling in pain, but it is what happens when their own prices were inflated. I am sorry, but Bitcoin and all the other big ones were pumped by hedge funds and banks and other institutions and those prices were definitely inflated. Much like what happened with crypto is going to happen with the stock market, where everything will fall, except that due to the negligence and overconfidence of hedge funds and other participating members shorting GameStop and AMC, the result will be opposite of falling. Since the stock is being suppressed, once everything falls, they will default and that is when we get our tendies. To conclude, hedge funds are in an ever-desperate point where nothing they do works. The massive amounts of cash they have is losing value, people are buying more stocks and the amount of people is growing by the day. Even worse, the very same companies they have shorted are now starting to make huge comebacks, which will incite institutional investors to come in, making managing the prices and shorting them even more difficult. Even with these things, however, there is a bigger clock ticking, and its sound is louder by the day. Inflation is slowly approaching, and as I have said, I do believe the economic crash to be the one to set the rockets off. Inflation is so far the biggest threat to Wall Street, as nothing they do works to alleviate their positions. This can quite literally only end one way, and it's with a market crash, and I think that is the latest we would squeeze. There are other factors that might trigger the squeeze, but I highly doubt anything will be strong enough except for the collapse of everything in the economic sector, and it seems to me so far that inflation is the issue that is leading our way into the squeeze. I hope this explanation was clear. It was an incredible amount of work, and even now having reviewed it a couple of times I'm not still certain it was clear, so please do let me know in the comments below how you feel about it. With that, let's talk about today. Today AMC had some really great news, with Craft AI enhanced US large cap momentum ETF loading up on AMC shares while also selling its majority holdings of Facebook and Walmart. This ETF functions at the behest of an AI, and it is known for accurately predicting movement of shares. I previously said on a video last week that one of the best reasons why AMC is not going anywhere is because companies are slowly going to come and realize that the business model of the company is good, and that bullish order flow consistently outperforms the sell order flow, and that this will bring investors in because it will make this company's stock act as a hedge against poor market conditions. But the glory isn't exclusive to this ETF alone. State Street Corp reported a 406% increase in ownership of AMC stocks, with the total valued over $66 million. This is an amazing bullish sign that AMC as a company is performing great, and should serve as proof that the stock is manipulated to the brink. All this bullish volume and the stock ends the day below the price it closed out on Friday? It should serve as confirmation. This amount of volume should have sent us parabolic. But as if these news weren't bullish enough, Taroso Investments purchased a new position in GME, acquiring 4,864 shares of stock valued at almost $1 million. This comes after Senvest Management increased their GameStop position by 56%, now owning 5,050,915 shares of AMC worth $95,159,000. Morgan Stanley also increased their GameStop position by 114%, owning 4,275,838 shares of the stock. The amount of companies buying GameStop is insane, and now companies are buying AMC in bulk. Both these stocks should be moving one way only, and the fact that it isn't should be counted as a blessing, because it lets you get more for less. I am just glad it wasn't long since I made that video that we started seeing the market slowly warm up to our stocks. I will link this video in the description below for you to watch it. There is a lot of stuff covered there that people should be aware of. Black Widow had the biggest domestic box office since everything went bonkers last year. The film had a great $80 million debut, with an additional $60 million from Disney Plus sales. This goes to show the very thing that I have been saying for months, and that is that theaters can and will coexist with movie streaming services. People want and will continue going to theaters because the experience they offer is not comparable to that which you get from watching movies at your home. As if that wasn't enough, AMC Adam Aron took to Twitter to announce that UFC's last event set another post-reopening attendance record this weekend, with more than 2.5 million US guests and 3.2 million globally. I literally am drooling over what the next quarterly earnings is going to be for AMC, and how many new institutions are going to be buying into the stock. This shows that the new initiative from AMC to diversify on the content they sell is extremely popular, and will for sure have a big substantial impact on their earnings and future. You can also expect their loyalty rewards program to get a boost in people, which further fills up their pockets. AMC and GameStop are just both unstoppable forces, and I am loving them more by the day. Today the Fed conducted reverse repo operations totaling over $776 billion. Dark pool trading for AMC accounted for 70% of all of its volume, the biggest we have ever seen to date. This marks another example that shows hedge fund aggressive expansion in their operations to defeat the price. GameStop dark pool trading accounted for 53% of all the volume, another increase by hedge funds. Let's finish the video by recapping today and talking where we might be heading into. AMC had a pretty ugly fall upon pre-market opening, with the stock diving down almost to 43. AMC bounced up but was unable to even reach the previous resistance point above $46. It fell again and continued moving above and below the VWAP line. This showed that the stock had a ton of volatility and strength, with a lot of momentum building up for a cathartic run. Right upon market opening, AMC slightly fell before running almost vertical, reaching past 46.50. The stock then dipped below the VWAP, which it soon broke past its resistance by was pushed under it again, debilitating the support and sending it on a downward spiral, testing the lower band of VWAP at $42. The stock had a small bounce, but even that was attacked with a precise and effect short ladder attack which sent the stock down to a closing price of 42.61. We are heavily, and I mean super heavily oversold, and I think tomorrow there is a high probability we test $39 and there is a strong chance AMC continues dipping throughout the rest of the week. On the 30-day chart, we see that the stock is on a bearish wedge, and though it is closer to breaking out of the resistance, the new aggressiveness hedge funds have demonstrated makes me think we will go down to test $36. As you can see, 38.76 and 36.01 are the next support lines for AMC, while 45.20 and $50 are the biggest resistance lines for AMC. If by Wednesday we are trading around 35, that could indicate the stock testing $30 by Friday. This wedge is incredibly important and AMC really needs to break out of the resistance if it wants to maintain these high levels longer, and a failure to do so will cause the stock to fall. Again, the price action AMC is experiencing is bullish in the sense that we know the price and legitimate value of the stock are very different. As such, this dip presents the perfect buying opportunity to keep acquiring shares at a discount before we get another stock surge or the squeeze. GameStop traded very similar. Upon market opening, the stock fell almost to 187 before bouncing up to 197. After that, the stock went to move above and below the VWAP before eventually being dipped in a single vertical attack. The stock was never able to find firm support, and each high it made throughout the rest of the day was lower than the previous one. The stock closed at 189.25, and below the VWAP as well. I think the stock is extremely oversold, but that will not matter. When taking a look at the 30-day chart, we see that the stock has been trading in a range between 177 and 220 for a couple of weeks, and that its last bounce off of the support was very short-lived. We are currently in a channel as well, as you can see. I think hedge funds want to break this 177 once and for all by Friday, which is why the attacks started so early in the week. We are now about to enter the weird dark times. Remember that trading these two stocks is a very volatile experience. We get crazy highs that are followed by boring sideways trading. What we are focusing right now is on reaching and elevating the price floors for each over elongated periods of time, so don't sweat this too much, as it is simply part of the process. Remember that all content on this video is subject to my own research and opinion, and that I am not a financial advisor. And with that, I want to thank you all so very much for making it to the end of the video. I have missed you guys a ton, and I know it sucks I wasn't able to release the DD yesterday, but I truly believe that extra time made it much better, so I do not regret delaying it. Let me know how you feel about it below. Again, thank you all for being here, and a huge shout out to all the donors of this channel. Please consider showing some love if you like this type of content, and I will see you tomorrow on the next one.